Hello everyone, this is a short little video about the new Federal Reserve policies to support the financial markets during the coronavirus pandemic. The Federal Reserve is one of the most powerful organizations in the economy, and in dealing with the coronavirus pandemic it has actually expanded its powers tremendously and doing entirely new things with the goal of helping the economy successfully make it through this pandemic. Now, to understand these new powers that the Federal Reserve is doing and its new role in the economy, you need to keep in mind what its traditional role has been. Historically, the role of the Federal Reserve has been to use interest rates to affect the economy with the goal of keeping low inflation and low employment. This is the dual mandate that the Federal Reserve has. Also, its original founding purpose was to be the lender of last resort to financial institutions, to keep them going through periods of panic and financial stress. However, in the new crisis that we're going through, the Federal Reserve has stepped up its powers to really become the source of credit support to important financial markets that are deemed necessary to the economy. Historically, the Fed has worked through the banking channels to get to important financial markets. Now, in this crisis, it's directly going into credit markets to provide the credit that key parts of the economy needed. Now, to get to an understanding of this, how quickly we've gone from traditional roles of the Fed to these more expanded roles, it's important to keep in mind how quickly the economy has changed during this crisis. And the Fed has really tried to stay out in front through the crisis. The Fed acted very early in the coronavirus economic problems by cutting the federal funds rate from 1% down to the range of 0 to 0.25%. On March 15th, it actually announced that it was going to buy $500 billion in securities and $200 billion in mortgage-backed securities. This was a big step, but it actually was similar to what it had done during the period of quantitative easing after the financial crisis in 2008. What came as new during this crisis is the April 6th announcement, where the Federal Reserve said it was going to buy $600 billion in corporate debt, company debt, and $500 billion in city and state debt, particularly what's described as the municipal bond market. The Federal Reserve 3 days later stepped up with an even bigger announcement that it was going to buy up to $2.3 trillion in municipal and corporate bonds to really flood those particular markets with enough credit to keep them going through this crisis. Now, there's two ways to kind of be thinking about what's going on. First, one thing is sort of the goals of the Federal Reserve policy. The principal goal originally was to lower the interest rates. Now the problem was an awful lot of the lower interest rates were not going into key financial markets. The traditional Fed policy of lowering the federal funds rate did bring the federal funds rate down, but it was not having a big impact on these financial markets. One of the reasons was because many of the lenders in these markets, the investors who buy the bonds, were really worried about the risk of corporate failure, the risk of municipal bankruptcies, and this was making them hesitant to buy these bonds. So going into these markets helped lower the interest rates in these markets. Now, another part is to put large amounts of money into these markets to keep them functioning. In other words, the Fed was acting as the buyer, and that was providing the cash in these markets to keep them going. This is described often in the terms liquidity support. And another key thing is to provide the companies, these large corporations, and also local governments, state and local governments, municipalities, with the money that would help them function through the crisis. An awful lot of corporations and also cities and states borrow routinely on the bond markets to help smooth out their spending over the course of a year. Right now, corporations have seen a large drop in their revenue, and cities and states have seen a large drop in tax revenue. In order to keep functioning and doing the things that they need to do, they need to get credit from someplace, and that's primarily what these markets do. And so the Fed has really stepped up and really channeling credit to these specific parts of the economy. Now, one way of looking at this is from the view of what's referred to as the loanable funds market. Loanable funds market basically sets up a market where the interest rate works as the price for money, and you have the supply of the market, right? The investors who buy the bonds to lend money. They are in essence supplying the money to the market. On the demand side, you have the companies and cities that sell bonds to borrow money. And historically, this market works just fine. It doesn't need an awful lot of government support. It naturally reaches an equilibrium interest rate through the buying and the selling of bonds. And the interest rate works as the price of money, and the interest rate for these bonds is often based on the amount of risk that the investors are taking in lending their money to corporations, to states, and to cities. Now, what happened with the impact of coronavirus is that an awful lot of investors decided they wanted to buy fewer bonds, mainly because there was a heightened risk. Again, corporations are not bringing in revenue from sales. Cities and states aren't bringing in revenue through taxes. And so the result was the supply curve moved inwards, right, because investors were not supplying money into the market. And this meant that interest rates were going up. The problem with interest rates going up is it puts a greater financial stress on corporations and cities and states during this time period where they're spending lots of money to fight the crisis. This is especially true for a lot of cities and states. So the Federal Reserve policy has been to go out and basically supply lots of money into the loanable funds market by buying lots and lots and lots of bonds. And the result is to try and push down the interest rate in this market to make it cheaper for seizing states and companies to manage their risk during this downturn. And basically, in doing this, one of the things that the Fed has also done is acted as a backstop in this market by basically assuming an awful lot of the risk. And this is designed to make it easier for investors to actually be involved in this market as well. So the loanable funds market gives you an idea of how Federal Reserve policy is affecting interest rates. But a second view of what's going on might be to kind of follow the flow of money and bonds between the different sectors of what's going on right now. Traditionally, you have a situation where corporations and cities sell bonds to borrow money, right? Keep in mind that a bond is a financial instrument, and buying it, the buyer of it, assumes some risk. The investors are basically lending money to the borrowers. And so what you see historically going on is the investors buy the bonds, and the money then flows to the corporations and the cities. Now, the corporations and cities are able to invest this money to build capital. Think about corporations investing in factories and so forth. Think about cities building infrastructure. And these corporations and cities will make payment over time to the investors, basically to pay back the initial borrowing, but also to compensate them for the risk involved in lending the money over a long period of time. Now, what we have going on now is that the Federal Reserve is stepping into this market to buy bonds. And the Federal Reserve basically has a special role to play here. And the special role that the Federal Reserve has comes from its specific legal power to literally create money. The Federal Reserve basically can create money and then use that money that's created to go out and buy all kinds of things. In this case, it's going off and it's creating money, trillions of dollars of money now, and going off and buying bonds. And in buying bonds, it's basically buying it from the investors who have already purchased the bonds. And in this way, the Federal Reserve is injecting the money into financial markets. Now, what also is happening here is that the Federal Reserve basically is taking on the risk, because the cities and corporations, the risk involved in their bonds now passes on to the Federal Reserve, which is holding the bonds on its balance sheet. The Fed has done some things to try and minimize its risk and protect itself from the downside, but in essence it is holding these bonds on its balance sheet. And the reality is that the corporations and cities that issued these bonds are now basically paying their interest payments directly to the Federal Reserve. The Federal Reserve purchase has actually put a lot more money, cash, back in the hands of the investors who historically are buying the bonds in these markets. And this putting the money back in the form of investors, hopefully the investors will now think that the bond market is safe because they can turn around and sell it to the Federal Reserve, and hopefully they will go and they'll be more willing to lend more money to corporations and cities to help get them through this crisis. So, again, this is a historic move on the part of the Federal Reserve. The Federal Reserve is directly supplying credit to key parts of the economy, and basically the idea of this radical step is to help cities and towns get the funding they need to go through this crisis, and basically take that risk away from being on the shoulders of the investors, who were quite hesitant to take on this risk because, again, no one quite knows when this crisis will end, and that lack of the ability to focus on the future makes it hard to really calculate out the risk that's involved and set an appropriate interest rate. One thing should be noted, that hopefully when the economy recovers, the Federal Reserve will be holding these bonds, but they'll be collecting the interest payments on it. If the Federal Reserve wants to pull some of this money out of these markets that is injected into these markets, it can always sell these bonds back into the market and collect up the cash, and therefore try and mop up some of this cash that's out there in the economy because of this radical actions that the Federal Reserve has taken over the past couple weeks.